Here's a number that should stop you cold. $12.4 billion. That's what GE Aerospace just printed in a single quarter. And analysts were expecting $10.7 billion. That's not a beat, that's a blowout.
And the stock has more than doubled from its lows 18 months ago. The market is clearly paying attention to what's happening inside those turbofan blades.
We're talking about GE Aerospace, the company that Larry Culp spent 7 years turning from a sprawling industrial conglomerate into the cleanest, leanest, pure-play jet engine business on the planet. And today we're breaking down exactly how they did it and whether the best is still ahead. I'm Hudson Thomas.
I'm Lana Chen. This is Charged Alpha.
So let's start from the top. GE Aerospace, ticker GE, part of the S&P 500 industrial sector. But before we get into what the company is today, we need to talk about what it used to be, because the contrast is honestly stunning.
General Electric was once considered the gold standard of American industry. At its peak in the early 2000s, it was the most valuable company in the world. But over the following 2 decades, it became a cautionary tale about over-diversification. Financial services, healthcare, power, aviation, oil and gas, GE had its fingers in everything, and the debt load nearly sank the ship.
And then Larry Culp showed up in 2018, the first outside CEO in GE's 130-year history, and methodically started dismantling the empire to save the core. He spun off GE Healthcare. He spun off GE Vernova, the power and renewable energy business. And what's left standing as of April 2024 is GE Aerospace. Pure, clean, focused.
The business today has 2 segments. Commercial engines and services, which they call CES, accounts for roughly 72% of revenue. That's the LEAP engine, the GE9X, the GE90, the CFM56. These are the engines that power the planes you fly on every day. The other segment is Defense and Propulsion Technologies, DPT, covering military engines like the F-110, the T-700, and the T-901.
Founded in 1892, headquartered in Evendale, Ohio, about 50,000 employees globally. And here's the number that really tells the story of why this company prints money. They have over 44,000 engines in service around the world. Every one of those engines needs maintenance, inspection, overhaul. That aftermarket services business is the engine of their earnings, pun fully intended.
The moat here is genuinely formidable. Once an airline certifies its pilots and maintenance crews on a GE engine family, switching to Pratt & Whitney costs hundreds of millions in retraining, retooling, and recertification. And the backlog sits north of $160 billion. That's 8+ years of forward revenue already locked in.
The why now moment is simple. Commercial aviation is in a supercycle. Air travel demand has fully recovered post-pandemic and is growing again. Airlines are aging their fleets through peak maintenance intervals, and Boeing and Airbus are ramping production on the very planes that use LEAP engines. GE is at the center of all of it. Let's talk about Larry Culp, because understanding GE Aerospace in 2026 is almost impossible without understanding the man who rebuilt it. H. Lawrence Culp, Jr., Chairman and CEO since October 2018, 8 years in the chair.
Before GE, Culp ran Danaher Corporation for 13 years, from 2001 to 2014. He grew Danaher from a $9 billion industrial company into a $50 billion powerhouse by acquiring and then dramatically improving businesses using a lean management system called DBS, the Danaher Business System. He holds an MBA from Harvard Business School.
And when the GE board reached out to him in 2018, the company was essentially on fire. $17 billion in charges. The stock had lost 70% of its value from its peak. The board needed someone who could make hard decisions fast. And Culp delivered, reducing net debt from over $130 billion to today's position, which is actually net cash positive. He flipped the balance sheet from a liability to an asset.
His reputation in the analyst community is strong. He's known for operational discipline, for exiting businesses that don't fit, and for being straight with investors about what he can and cannot control. The guidance raises he's delivered over the past 2 years have been consistent. That builds credibility, and credibility is how you sustain a premium multiple.
Culp also brought the Danaher Lean playbook into GE Aviation, driving margin expansion that skeptics thought was impossible given the company's cost structure. The proof is in the numbers. And Lana, I think this is a good time to dig into those numbers.
Let's do it. All right. Price as of today, $299.60. Market cap, $316 billion. That puts GE among the 30 largest companies in the S&P 500.
So it's a genuine mega cap at this point.
It is. Now on valuation, and this is where it gets interesting. The trailing PE is 36.8 times. The forward PE is 41.3 times. Both of those are premium multiples for an industrial company. The price-to-sales ratio is 6.5 times, and price-to-book is 17.6 times.
Those are not value stock numbers.
They're not. But valuation multiples need to be understood in context. GE Aerospace is not a typical industrial. It has a services-heavy revenue mix that carries gross margins north of 40% in the aftermarket business. The market is pricing in the quality of those earnings, not just the volume.
Walk us through the income statement.
TTM revenue is $48.4 billion. Year-over-year revenue growth is 24.7%, which is exceptional for a company this size. TTM EPS is $8.15. But Q1 2026 just hit differently. $12.4 billion in quarterly revenue against estimates of $10.7 billion, a beat of 15.6%. Adjusted EPS of $1.86 against estimates of $1.68. That's a 10.7% beat on the bottom line.
What's driving that kind of revenue beat?
Two things. LEAP engine deliveries were up 63% year over year in the quarter. That's the narrow-body engine that goes on the Boeing 737 MAX and the Airbus A320neo. And commercial services revenue was up 39%, driven by shop visits, older engines coming in for major overhaul. The combination of new engine deliveries plus services is a powerful double engine of growth.
Now let's talk about the margins.
Gross margin is 34.8% on a TTM basis. Operating margin is 18.5%. Net margin is 17.9%. Those are meaningfully above where GE operated 5 years ago, and the trajectory is upward as services, which carry the highest margins, grow as a share of the mix.
And cash flow, because cash flow is where GE's story really shines.
TTM operating cash flow is $7.028 billion. Free cash flow after CapEx is $5.632 billion. The company is generating serious cash, and management raised full-year 2026 free cash flow guidance to $6.3 to $6.8 billion. That's a business that generates real money.
Balance sheet.
This is the transformation story in one number. Net debt of negative $8.878 billion. That means GE Aerospace has a net cash position. They hold $10.98 billion in cash against only $2.1 billion in total debt. 4 years ago, GE was drowning in over $100 billion in net debt. Today, they have a war chest.
And they're using it.
They are. A $15 billion share repurchase program is active, and the dividend yield sits at a modest 0.52%. But the total shareholder yield, including buybacks, is closer to 3.7%. Return on equity is 47.9%. Overall, GE Aerospace's financial health is strong, driven by exceptional cash generation, a fortress balance sheet, and revenue growth that is accelerating, not decelerating.
So what does Wall Street make of all this? Lana, what's the consensus?
Strongly bullish. Of 21 analysts covering GE Aerospace, 18 have a buy or equivalent rating, 2 have a hold, and only 1 has a sell. The consensus is firmly buy. The average price target is $350, about 16.8% above today's price.
And the target range?
Price target low is $280, high is $425. So the bull camp thinks there's another 40% of upside from here, while the bears think we're roughly fairly valued.
Who are the notable bulls?
JP Morgan has an overweight with a 380 target, UBS is at buy, 375, Citigroup buy at 360, Bank of America buy at 355, Bernstein outperform at 340. The institutional community is broadly aligned that the GE transformation story has more room to run.
And on last earnings, we already hit the headline numbers, but was there anything specific in the call that moved the narrative?
The guidance raise was the key catalyst. Culp raised full-year 2026 operating profit guidance to 7.8 to 8.2 billion. For context, they printed 7 billion in fiscal 2025, so they're guiding to meaningful earnings acceleration. The market responded well. The stock was up roughly 6% in the 2 days following the report.
That's a strong signal of confidence in the execution. All right, let's play it out. Starting with the bull case, because there's a lot to like here.
Let's hear it.
Bull case thesis number one, the backlog. Over $160 billion locked in. That is not revenue guidance, that is revenue obligation. Airlines have signed contracts, that money is coming in. We're talking 8+ years of forward visibility at current delivery rates. Most companies would kill for 1 year. Bull case number two, the shop visit wave. Think about this. In 2010 to 2015, GE delivered a huge cohort of GE90 and early LEAP engines onto planes that are now reaching their first major overhaul interval, which typically comes around the 12 to 15-year mark. That means the high-margin services business is about to be flooded with work for the next 5 to 7 years. This isn't speculation. It's a function of physics and the installed base. 3. LEAP deliveries are accelerating, up 63% in a single quarter. As Boeing and Airbus ramp production on the 737 MAX and A320neo, GE captures every single narrow-body engine that goes on those planes through the CFM joint venture with Safran. And each new engine delivered today becomes a services customer for the next 30 years. 4. The T901 program. GE won the Army's Improved Turbine Engine Program contract to replace the T-700 in Black Hawk and Apache helicopters. That's a $5 billion+ program with decades of follow-on services. Defense diversification at exactly the right time. And 5. Capital returns. Nearly $9 billion in net cash. 15 billion buyback authorized. The share count is shrinking. Each dollar of earnings is shared among fewer shares every quarter. That's a structural earnings per share tailwind.
Strong case. Now the bear side, because there are real risks here. Bear thesis 1, supply chain. GE wants to deliver more LEAP engines. Airlines want more LEAP engines. The constraint isn't demand, it's ceramic matrix composites, titanium forgings, and precision castings that the supply chain can't produce fast enough. Delivery delay is a dollar of backlog that stays backlog instead of becoming revenue. 2. China exposure. Approximately 20% of commercial engine revenue comes from Chinese carriers. GE holds export licenses for CFMI engines into China, but those licenses are politically sensitive. If trade tensions escalate, and we've seen the tariff environment become increasingly uncertain, China revenue could be impaired materially. That's a binary risk with no easy hedge. 3. Valuation. 41 times forward earnings is a high bar. If GE misses a guidance metric by even 5%, the multiple compression alone could cause a double-digit stock decline. High-quality companies with premium multiples have further to fall when execution stumbles. 4. Defense headwinds. DOGE, the Department of Government Efficiency, is reviewing military contracts. The DPT segment depends on defense budgets that are now under political pressure. Not an existential risk, but a headwind. 5. Pratt & Whitney is not going away. RTX's geared turbofan engine is competing hard for every A320neo order renewal. If Pratt closes the fuel efficiency gap with LEAP, GE could face market share pressure in future narrow-body cycles. Competition makes moats work harder.
Both sides of that trade are legitimate. This is a high-quality company priced for high expectations. The bull wins if execution stays tight. The bear wins if anything slips. Let's benchmark GE against its peer group. Who are we comparing?
3 companies that give us good context. Raytheon Technologies, ticker RTX, which competes directly in commercial aero through Pratt & Whitney. Lockheed Martin, LMT, the pure-play defense prime. And Transdigm, TDG, the aerospace aftermarket pure-play.
Start with RTX.
RTX trades at 3.3 times price to sales. GE is at 6.5. RTX's PE is 34 times, similar to GE. Market cap is $138 billion versus GE's $316. RTX is cheaper on revenue, which makes sense because Raytheon's defense business carries lower margins than GE's commercial aftermarket. But if you're comparing the commercial aviation exposure specifically, GE's services franchise is considered higher quality.
Lockheed.
LMT is at 5.5 times price to sales. PE of 17.8, market cap of 115 billion. Pure defense, no commercial exposure. The lower PE reflects a more stable but slower growth business. Lockheed doesn't have the leap-driven revenue acceleration story, but it also doesn't have the China export risk.
And Transdig.
Transdig is the interesting comp. PS of 8.3, actually higher than GE, and PE of 42 times. Market cap is 70 billion. TDG is the master of sole-source aerospace aftermarket parts, with monopoly-like pricing power. The fact that GE is trading below Transdig's multiple on price to sales while having a much larger revenue base and a growing services mix is actually a case some bulls make for further multiple expansion in GE.
The takeaway being that the market might be undervaluing GE's services quality relative to Transdig.
That's the argument. Whether it's correct depends on how sticky and recurring GE's service revenue proves to be over the next decade.
Let's check the options market. What are traders saying with their money?
Implied volatility is sitting at the 55th percentile, elevated but not extreme, which makes sense the day Q1 earnings hit. The current IV level is 32.4%. The put-to-call ratio is 0.85, meaning more calls than puts are being bought, which reflects a slight bullish lean from options traders.
Where's the open interest clustering?
High OI is concentrated at the $300 strike, which is basically right at the current price, and at 320. The concentration at 300 suggests the market sees that as a near-term pivot level. If GE can hold 300 on any pullback, options traders seem positioned to benefit from a move toward 320 and beyond. One caveat, as always, options activity tells you where traders are positioned, not where the stock is going. Positioning can be wrong, and when big OI levels break, the unwind can amplify moves in either direction.
What are the insiders doing?
Over the past 6 months, one director buy 8 executive sells. Net share reduction of roughly 245,000 shares. The sells are predominantly executives monetizing stock-based compensation, which is routine and not a red flag on its own. When executives hold options with a strike price of 150 and the stock is at 300, selling is rational, not bearish.
No unusual clustering of sells ahead of bad news.
Nothing that stands out. The pattern looks like normal compensation liquid, not informed selling. That said, no major insider buys either, which at $300 a share isn't surprising. Conviction buys typically happen when executives think the market is significantly undervaluing the company.
If you're watching GE Aerospace from here, what are the signposts?
4 things I'd track. First and most important, LEAP delivery volumes versus quarterly targets. If GE is delivering engines below guidance pace, the supply chain thesis is breaking down. That shows up in the quarterly investor letter and earnings call. Second, shop visit growth rate. This is the heartbeat of the services business. Double-digit shop visit growth means the services revenue wave is arriving on schedule. Single-digit or declining growth would be a warning sign. Third, China news flow. Any escalation in export licensing restrictions, trade tariffs on aerospace components, or diplomatic deterioration between the U.S. and China gets immediately reflected in GE's commercial revenue outlook. This is a political risk that moves fast. Fourth, free cash flow conversion. Management guided to $6.3 to $6.8 billion in free cash flow for fiscal 2026. If they hit that or beat it, the buyback program stays funded, and the bull thesis stays intact. If CapEx requirements or working capital pressures compress FCF below guidance, investors will reassess the multiple.
The forward catalysts: Q2 earnings in July, Boeing's MAX ramp rate, T901 program milestones. A lot of good things in the pipeline if execution holds. All right, bottom line time. What's the GE Aerospace story in 1 minute?
GE Aerospace is the cleanest version of a company that Larry Culp spent nearly a decade building toward. It's an engine company with a $160 billion backlog, a services business growing at nearly 40%, a net cash balance sheet, and a management team that has consistently delivered on its promises. The Q1 2026 results weren't just a beat, they were a statement that the commercial aviation supercycle is real and GE is at its epicenter.
The risks are real too. A 41 times forward multiple is a high bar. China exposure is a genuine binary risk in today's trade environment. And the supply chain, ceramic matrix composites don't get manufactured overnight. This is a company where execution needs to stay tight for the premium to be justified.
The one metric to watch above all others: commercial engine shop visits. That number tells you whether the services wave is arriving, accelerating, or stalling. If shop visits keep growing at double-digit rates through 2027, GE's earnings power will likely exceed what's already priced in. That's the key to the whole story.
We always close with a quote that fits the company we just covered. For GE Aerospace, I landed on this one from Antoine de Saint-Exupéry, the French aviator and writer who gave us The Little Prince. He wrote, "Perfection is achieved, not when there is nothing more to add, but when there is nothing left to take away."
That's a perfect Larry Culp quote, even though it predates him by about 80 years.
Right? He spent 7 years taking things away from GE Capital, GE Healthcare, GE Vernova, until what remained was the most valuable and most focused version of the business. Saint-Exupéry would have appreciated the discipline. That's going to do it for this episode of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.